James, have you returned to us?
I have, yes. Sorry, I don't know
Ah,
what.
fantastic. No problem. I think what may have just happened is that I gave a substandard version of your presentation while using your slides, but without your considerable expertise. But I did my best.
Okay. I guess I disappeared from that connection quite early, did I?
You did, yeah. We could see your slides, but we unfortunately we couldn't hear your voice. But you're back now, which is great. Would you like to just say something very quickly to sum up the presentation you just gave?
Sure. Yeah. I mean, I think so the final slide was really focused on a couple of questions we had from customers over property, UK property funds in particular, and the suspension and redemptions that we've seen in those strategies of late. Really, I think there's two parts of the equation here. Do we think property is an interesting asset class that potentially can diversify portfolios? Yes, we do. We think property is actually a very interesting asset class. It's how you access it and ensuring that you have the appropriate liquidity that's required to manage portfolios. Our portfolios have always been focused on liquidity as a core attribute, and for a long time we've believed that there has been a mismatch between the daily liquidity offered by mutual funds focusing on property investments and the very different nature of liquidity for those underlying investments, the physical properties themselves. So for us, the mismatch has been clear for some time. There will be many investors now who are trapped in those UK property funds for the time being, and until sentiment returns and property valuers are able to get a more consistent view of property valuations in the UK, commercial property valuations. For us, an out-and-out focus on liquidity, it's a good example of why liquidity matters, and never more so than in volatile market conditions and in worsening economic conditions.
Smashing. Thank you, James. And thank you to all of our viewers who stuck with us over those technical challenges. Great to have you back, James. Let's move on to the Q&A session. We've had some really good questions in advance of today's session. One of them came from Robert, and it's about pensions. He asks, will you consider allowing pension fund holders to split investments across different risk levels? As I'm approaching retirement, I want to have some capital security, but I also want some exposure to risk. Rather than having all of my investments in one category, I would like to have, say, 80% of it in a level 2 or 3, that's a fairly low risk type of portfolio, and 20% of it in level 8 or 9, that's a fairly high risk type of portfolio. Then Robert says he'd like to have the facility to switch between these two different pots. So here we are, James. Here's a question about how to manage your pension pots. So do you have any thoughts about that?
Yeah, sure. So I think the first thing to think about here is where you are on your pension journey. So if, for example, you're like you, George, and you're in your 30s and therefore still in what we call the accumulation phase, that's when you're growing your pension pot. I think it's really helpful to think about retirement as one goal. That is the total amount of money that you'd like to live on in retirement. And how big a pension pot you're going to need to achieve that. And we have a pension calculator, a Nutmeg, that will help you with these sums. There are other pension calculators and tools that can help you with understanding what that sort of total retirement picture needs to look like. I think in this case, Robert, you said you're approaching retirement, and there are a couple of different schools of thoughts here, really, about splitting your pension income into different pots, depending on how you intend to use it. So some people like to think about their retirement income similarly to the way they split their income now. A portion of their income is needed to cover the sort of essential spending, and then a portion is left over for the more discretionary spending, the fun stuff, the treats, if you like. And so, shortly after the introduction of the pension freedoms in 2015, they gave people much more options about what to do with your retirement pot. There was an increase in people who would use a portion of that pension pot to purchase an annuity. That annuity would cover the essential spending, the electricity, the heating bills, the home, the water and food, and then they would have a portion of that pension left for discretionary spending, which might be holidays or home improvements, for example. So, allowing different pots or portfolios within a pension wrapper could, in theory, allow customers to do a similar thing. At the moment, this feature isn't available, but we're always focused on looking for customer feedback and ideas for improving the service, so we'll make sure we'll put that forward. I do think for the vast majority of people saving towards their retirement, actually focusing on that one retirement goal, having a consistent portfolio that allows you to understand in greater detail how your overall objective is going to be met is probably going to be most beneficial.
Thanks, James. We've got another question about pensions here, this time from Keith. I have 3 small pension plans with 3 separate providers that I would like to consolidate. And here I just had to mention that you're very welcome to consolidate them with Nutmeg, Keith, if you like. Keith asks, I'm not sure if I should create a new plan or transfer them to my current investment plan. Do you have any thoughts on that, James?
So I guess with people increasingly having a lot more than just one job over their lifetime, it's common to have more than one pension, and I myself had a number of pensions before moving to Nutmeg. There are a number of benefits to consolidating pensions in one place. Similarly to the point I just made before, it can really help you have a much clearer picture of what your financial situation is, and help you really understand whether you're on track for the type of retirement that you want or not. And you can, of course, keep your pension with different providers and amalgamate those different valuations that you receive. But often it's much easier if they're all in one place, and you have a really consistent view of your likely retirement outcome. And I think it can help reduce also how much you're paying in fees. Give you a much clearer picture, and given your pension will often be a very long-term investment. The fees are going to have a really significant impact on how much of your investment returns you keep and how much of those returns are eaten away by fees. So of course you won't forget that. It also means you won't forget where any of them are. And this is a really interesting point. I think there are an estimated 1.6 million unclaimed pension pots in the UK. So people often move employers, leave behind a pension pot, and then over time forget about it. So it's not as uncommon as you might think to do that. And therefore, if you are going to keep your pension investments in different places, it's really important to keep track of them. Now, deciding who manages that money is obviously a personal choice, and whether that's an existing provider or a new one. I would say before you move any pensions, it's really worth checking if any of your pensions have specific benefits, such as generous death benefits. They're particularly common with final salary schemes or defined benefit schemes, or larger pension schemes from large corporate employers. So it's really important to analyze the detail, and it will get help in analyzing that detail and understanding whether it makes sense for you in terms of benefits to move your pensions. We do offer some of that advice if you'd like Nutmeg to help with that. If you'd like to know more about consolidating your pension here, visit nutmeg.com/pensions. That will provide you with all the information you'll need and who you need to contact at Nutmeg to gain that help if you require it.
Yes, thank you, James. I was in a similar position to you prior to coming to Nutmeg. I had more than one pension scheme, and speaking purely from my own point of view, it was quite reassuring to be able to put all of those together just into the one place, which in my case is a Nutmeg pension. But absolutely echo what James has said. If you're lucky enough to have a final salary pension scheme or some variation of that, think very carefully before you move that, because you may give up some benefits in the process. Right, let's talk a bit about stock markets. So Scott has as well as other viewers such as Amar, have some concerns. So I'm going to read out Scott's question. I'm constantly reading, mainly from articles in the US, that the market will revisit the extreme lows of a few weeks ago, perhaps in around August of this year. Do you foresee this happening, James? Keeping in mind how well the market has rebounded of late. I think what he means there is, we've had a big rebound, but are we potentially going to give some of that rebound back? And if that does happen, if we do see extreme lows around August this year, are we at Nutmeg, as the investment team, are you in a better position this time around to minimise the impacts on portfolios and perhaps prevent them dropping as much as they dropped during the recent volatility? What's your view on that, James?
So I think this links a lot to the discussion we've had in recent weeks about the trajectory of the virus and also about limiting the second round economic effects. So, as you said before, calling the bottoms in markets is very hard, as in fact is calling the peaks. But it would appear that we're probably through the worst of the market volatility in terms of investor panic. And given the fall we've seen in volatility since the bottom in the market, the sort of significant increase in both magnitude and coordination of stimulus efforts globally, and the progress we've also seen on the medical outcomes, as a result of the drastic measures that we've taken to lock down economies, I think then to retest the lows of the market in March would really mean that we'd need to see a really significant deterioration in the medical outcomes or significant second round effects on the global economy. So right now it feels like we're unlikely to retest that lows. That doesn't mean that stock markets can't fall from here or that the recovery will be linear. As mentioned in the slides, we're about to enter earnings season. That will give investors a first opportunity to assess the damage at a corporate level and to really understand how businesses are positioning for the months ahead. That's likely to contain a number of surprises, both good and bad. And I think with a demand and a supply shock of this magnitude, it's unlikely that there won't be any secondary economic effects in the coming months. And after all, that's what this unprecedented action, the stimulus that's being undertaken by governments and central banks is really seeking to limit. So in some ways, it will be the success of those stimulus programs in shoring up the economy that will really likely determine whether we see those lows retested. On portfolios, as we always say, we always position portfolios for how we perceive the medium-term balance of risk and reward based on the prevailing macroeconomic outlook. We do remain cautious. We've added selectively to some equity market holdings earlier in April. We have increased our investment-grade corporate bond exposure, but as always, we will adapt our portfolios to the environment, and we stand ready to make changes if they're required.
Thanks, James. Here we have another question on your favourite topic, which is ETFs. Apologies if this repeats some of the material I mentioned earlier, but here's Simon's question. Regarding the impact ETFs have had on the volatility of the markets in recent weeks, he asks, their share of trading activity is much greater than in 2008 and 9 when we had the global financial crisis. He wonders, is it possible to identify the impact that ETFs have had on the kind of volatility we've seen lately?
So I think one of the reasons we built our investment propositions around ETFs at Nutmeg is because they are so scalable and because they're highly liquid. And I think, when we look at what's happened in the past couple of months, what we've seen in the past 6 weeks, rather, what we've seen is global ETF trading volumes have grown really significantly in the month of March, both in absolute terms, but also as a share of wider stock market trading volumes. And in the US, ETF trading volumes, in fact, reached about 38% of equity trading activity. So of all activity in the stock market, the trading of ETFs is about 38% of that. That eclipses levels that were last seen at the end of 2018 in that bout of stock market volatility. And I think what this really demonstrates is that there is a real significant depth of market liquidity in the ETF market. So the assets invested in US ETFs account for around 16% of the US stock market. So 15% of the US stock market, but around 40% of volumes. And what we saw actually is that trading volumes were particularly high in fixed income assets such as high yield bonds, where ETFs are acting as a liquidity tool for those investors in the high yield bond market. Close to home in the London Stock Exchange, what we saw is high yield bond ETFs trading volumes in March of around 6.5 billion. So that is pretty significant given their asset base is about 9.4 billion. So they're acting a little bit as a release valve for the wider market. And we did see the cost of trading ETFs increase somewhat over the past 6 weeks. As you might imagine, this is something we pay a lot of attention to. But this is really a reflection of increased cost of liquidity in many of the underlying markets. And I think what this whole picture tells you is that ETFs are the sort of liquidity tool that are being used across a range of different investors. So when investors need liquidity, they're turning to the ETF market because of this unique secondary market aspect, the ability to buy and sell ETF shares without transacting in the underlying assets, and the transparency that gives you pre-trading in terms of the cost of liquidity. And this is very different to mutual funds. When you trade in a mutual fund, you don't know the cost that you're going to get. If we traded today in a mutual fund, that price wouldn't be set until midday tomorrow or 1 p.m. tomorrow. So with an ETF, we understand before we transact exactly what the cost of. And we know in Europe that the vast majority of ETF investors are institutions, and that's why we've previously described them as one of the investment industry's best kept secrets. And I think what you're seeing here is that sophisticated investors are really utilizing ETFs because they've offered a really efficient way to gain liquidity even in times of market stress.
Thank you, James. Let's go back to the topic of recession, which is something many of us are thinking about at the moment. Samuel asks, do you envisage the post-corona recovery being U-shaped or V-shaped in the US and Europe, Middle East, Africa? And does that differ compared to other regions, for instance, emerging market economies? So I think what Samuel means there, the V-shaped recovery is a short, sharp shock, a sharp on the way down and then quick to recover, and the U-shape might be a little bit more protracted. Is that right, James? That I've got the right description there?
Yeah, that's correct. And I think there are differing sort of views in what a V-shaped recession or a U-shaped recession actually sort of looks like, and what the lengths of either of those could be. I think the first thing to say here is that it is likely still a little bit too early to tell. As we previously said, we think if we continue to get rapid progress in controlling the virus from a medical perspective, and if the stimulus that's being pumped in by governments and central banks globally can support businesses and individuals through this period of really restrained economic activity, then there is reason to believe that the economic recovery could be rapid, and that's what you've seen in markets in the past week or so. Actually, is a rise in sentiment on that basis. And I think also, you saw that in the OBR report. I didn't mention that earlier because I didn't present the slide, but the Office for Budget Responsibility came out with their forecast this week for the UK economy, a 35% contraction in growth for the second quarter, but actually a recovery towards more normalized level of growth at the end of 2020, and positive growth in both the third quarter and fourth quarter. So that's including a 3-month shutdown in those forecasts. So there is reason to believe that if we can make strong progress, then a recovery could be rapid, and that sort of V-shaped, or maybe a V that looks a little bit more like a U shaped recovery could come into play. I think on the second part of the question, we are likely to see a lot of differentiation across economies. This situation is different to anything we've ever seen before. It isn't caused by a buildup of excess in the system, but it's much more a voluntary shutdown of economies. And what is different is the approach that different economies, different countries are taking to that, both medically and in terms of the restrictions that they're placing on activity, and then also the strength of the support measures that can be offered by different economies. And I think that means we are likely to see different outcomes. We'll see some slower recoveries, some quicker recoveries. The US, for example, the support packages that have been launched in the US have been significantly bigger than some of those in Europe. That's likely to support the economy there and support a quicker recovery if the medical aspects can be contained. In China, we've seen how China's been able to move very quickly, partly due to how it was able to enforce the economic shutdowns. That's going to be very different in other nations. Another example would be Singapore. Singapore moved very quickly to start off with, but is now facing a second wave of infections. So understanding whether that's possible in other locations, whether other economies will see a second wave of infections and therefore may have to extend lockdowns, for example. So I think it is really highly likely that you're going to see different paces of recovery in different regions, just as we're seeing really different paces of response to the medical crisis itself. And developed markets obviously have much more firepower in terms of support that they can offer their economies than emerging markets do. Many emerging market countries are already heavily indebted. They've got less developed response tools to start off with, both medically and in terms of other support tools for the economy. So another factor to add to that is the commodity price impact here as well. So it's easy to forget that we have seen a significant depreciation in commodity prices alongside coronavirus as an issue in the global economy, and that means that oil exporting nations, particularly those emerging market oil exporting nations, have really been hit hard with a double whammy. They've got not only the cost of responding to the crisis, but also falling revenues from much lower oil prices, and that's going to hinder their recovery. But on the flip side, many emerging market nations that are importers of commodities, that are net buyers of commodities, are now going to find that they have much lower input costs, and therefore that may aid their recovery. So we are going to see differentiation between developed and emerging, but also within developed and within emerging economies, I think.
Thanks, James. That's somewhat encouraging. I have to say, when I saw that 35% figure that the OBR had put out, I was quite shocked by it. It seems a very large number. But if we recover by the end of the year, perhaps not so bad. Market timing is now a good time to invest. This is a topic that understandably many of our viewers have questions about. If you're still with us, Peter Dixon, thank you for your question on this topic. I'm going to read out one from Andrew. What is Nutmeg's approach to increasing exposure to equities to take advantage of low prices? So that's what are you doing, James, with the fully managed and socially responsible portfolios? Andrew would also like to know, should he personally be increasing his risk profile if he can afford to lose money in the short term?
So yeah, good question. I think again we always seek to position our portfolios appropriately for that balance of risk reward, the medium term balance of risk reward, based on what we judge the macroeconomic outlook to be. And as I've mentioned in recent weeks, this isn't simply about the mix of equities and bonds in portfolios, but it's also about the types of assets in the portfolios and the types of assets that may be better suited for the prevailing environment. And we have seen quite a significant shift in terms of what the operating environment may look like in the coming months versus what it might have looked like a number of months ago. And so we've looked to add back to equities selectively earlier in April, where we felt it made sense to do so. But we're also looking at the mix of assets in the portfolio, and at the same time we do remain currently quite cautious on the medium term outlook, given the magnitude of the shock that we've had economically. And I think on risk levels, we really encourage our customers to set investment goals for the medium and the long term, and to not change these risk levels unless the investment goals or the time frame, the time horizon has changed. And by choosing a fully managed portfolio, you are in effect trusting our investment team to make those changes on your behalf and to manage the portfolio's risk level in line with our investment view, and therefore there shouldn't really be the need for you to change that risk level yourself.
Thanks, James. Time is getting on, so I think the next question will have to be our final question, but it's a good question, and we've had a couple of comments on it from different people. One of our viewers today, Unimatrix, has asked a question on this. And we also had a question that came in prior to this webcast from Charles. So I'm going to read out Charles's question, but it covers a similar topic to what you've asked, Unimatrix. With huge recent UK government spending promises, printing money is likely to be seen in the future to reduce the deficit. That means inflation and a declining sterling over time. Given that, first question, what is Nutmeg's approach to currency risk? And second question, is it right to be using the pound hedged classes of some ETFs? And Charles gives the example of a US equity ETF. So here we are, James, currency risk and the wisdom or not of currency hedging. Over to you.
Yeah, so I guess a couple of things to say on this. The first is that the UK is not the only one announcing a significant policy response. And in fact, the UK's overall package is actually smaller than countries such as Germany and France, and much smaller than the US. And of the package that's been announced, roughly 18% of GDP measures that have been announced as of the end of March in the UK, the vast bulk of this is actually in loan guarantees to backstop company operating liquidity. So to allow companies to continue operating as a going concern. And most of this will be repaid. So it's not really translating explicitly to a longer term government debt burden. And this compares with the US, for example, which has announced around 5.5% of GDP in immediate spending. Germany has announced 6.9% of immediate fiscal spending. So the UK's fiscal bill will no doubt be much higher than the amount that had been budgeted, but it's not clear that the relative spending is significantly higher and therefore will weigh on the pound sterling. I think there are also other things to think about when it comes to the currency, particularly the sterling, in the months ahead. As you mentioned, Brexit negotiations are about to begin. They may still even be resolved this year. It's likely we'll see some movement in the pound as a result of those. And then also bear in mind it doesn't have to just be a pound specific driver as well. What we've seen in recent months is really a trend of a very strong US dollar. We do have the US presidential election coming up in November, and therefore we might see some move around dollar strength that could impact GBP. I think when it comes to Nutmeg's view on currency risk and currency risk in our portfolios, as a starting point, we use a ratio of 50% to hedge all foreign currency exposure. So we're 50% hedged, and that includes our US equity exposure. But we view our currency exposure really as separate to the underlying components of the portfolio. So we're viewing our currency exposure at the portfolio level rather than the individual portfolio components, and that's why you might see some of the US market components with a higher hedging ratio, and that's because some of those ETFs are much cheaper and provide a much more efficient way to hedge currency than maybe other components in the portfolio. So it makes sense to utilize the cheapest components, the cheapest hedging components to implement the hedge. We are presently keeping our lower and medium risk portfolios a little bit below that 50% hedged threshold, and that really recognizes the balance of risk. But we look really to seek to implement our currency hedging as efficiently as possible, and therefore it's important for us to view hedging on a total portfolio basis rather than on an individual component basis. I hope that makes sense.
Thank you, James. And I think we're going to have to leave it there because time's getting on and James has to get back to work. Thank you, everyone, for joining us today. And apologies once more for this slight technical hitch. Thanks for sticking with us. If your question didn't get answered, please do tune in at the same time next week. That's 11 a.m. on Wednesday. We'll try to cover it then. We do try and cover everything that comes in. So if your specific question hasn't been answered and you don't think it's been satisfactorily answered, please do ask it again. I'll just quickly mention Trustpilot. If you've used Nutmeg and you have thoughts or comments about us, a great way to share that feedback is by leaving us a review. You can find the right page by searching for Nutmeg Trustpilot. That's the consumer review service. This kind of feedback is really helpful for us, and it may help other customers on their potential journey too. I also wanted to highlight that our partnership with Great Ormond Street Hospital Children's Charity is still ongoing. The charity relies on people's generosity to make a real difference to seriously ill children and young people. We're donating £25 for every Nutmeg Junior ISA account opened, and we'll also match any donations you make up to £100. You can learn more about this at nutmeg.com/JISA. capital is at risk and JISA rules apply. Thank you once again for tuning in, and we hope to see many of you next week.